U.S. home prices hitting an all-time high. Come again? What's going on? Why are these headlines saying this when it doesn't feel like the market is expanding? Let's talk about that. Today, we're going to dig into this article plus a few other things, one of which actually contradicts this and gives a broader picture and some context on what's going on. We're also going to talk about a new housing bill, what's happening with mortgage rates, and a new player in the real estate industry you guys may have heard about. Should we be taking it seriously? We're going to take a look, so let's jump in. Before we jump in, my name is Suri Atkins. I am a real estate agent with eXp Realty. I service North Phoenix, which includes Glendale, Peoria, Scottsdale, Cape Creek, and Carefree. I have a valuation and a seller net sheet tool in the description below. Please feel free to take a look at it. All right, so let's dive in this article. So this article from Redfin News says the U.S. home prices hit an all-time high, driven in part by big upticks in San Francisco and West Palm Beach. Location aside, why are we seeing home prices hit an all-time high? They say prices rose 2.2% year over year in June to a record high, mainly because of growing demand. Existing U.S. home sales ticked up to a seasonably adjusted annual rate of 4.4 million, the highest level since 2022, and pending home sales reached their second highest level since 2023. I also saw another article saying we've had the longest run up of home prices we've ever seen. So, what's actually happening here? All of it true, but there are a few other things at play. I turn to HousingWire a lot for a lot of great information, especially Logan Mastami. He's geeking out on this every day, and I love it. He says housing affordability is improving because wages are outpacing home price growth. A totally different perspective. So I pulled up this article. So even though home prices hit an all-time high, the growth rate has cooled down. The key shift, annual growth is at 1.8%. And while wages are raising at 3.5%, we're still have seen a growth in home prices. It's just at a slower pace, slower than wages are increasing. This is actually a really good news for the market because it's balancing us out. It's stabilizing us. We're not seeing high highs. We're not seeing low lows. Things are starting to correct a bit. Inventory is still at 1.56 billion at 4.6 months of supply, which can limit future price acceleration. He's looking at this nationally, not just Phoenix. He went on Yahoo Finance to talk about the housing market in getting healthier. It's very normal for home prices to rise. In fact, if you exclude 2007 and 2011, home prices have fallen by 1% since 1942. And in 1990, we were down 0.7%. He has this graph showing prices since 1942, and you can see the increase every single year except for the great financial crisis that and that small dip in 1990. So it's really not normal for us to see anything other than home price appreciation over time. However, you may have outliers like the GFC. That's everyone's little gun shy about what's happening again, especially after such a huge run up in prices over the last few years. It feels like we're waiting for the other shoe to drop. He says, as you can see, we've had many years when real home prices fell, meaning the growth rate of prices is lower than the growth rate of inflation. This year is a good example. The growth rate of prices is running below the growth rate of inflation and wage growth. For example, home prices are up 1% this year, but wage growth is running 3.5% and inflation at 3%. That kind of year actually helps affordability over time. So even though we're seeing that increase in home prices, it's actually soft this year. Overall, this is really good news for the housing market, more of a stabilization, a bit more normalcy. So when you see these headlines about record home prices, you have to factor in inflation and wages too. So, what's been going on in Phoenix? The Comfort Report condensed a market summary for the beginning of July, showing year over year and month over month change across a number of metrics. So, active listings, which excludes under contract and contingent, are down 4.3% year over year and down 3.6% month over month. Remember, I've been tracking this. This is one of the first times we've fallen below the previous year in active listings, and that trend has continued. Same story, including under contract and contingent listings. So we also have a lower number of pending listings month over month. But year over year, we actually have more pending listings than we did last year at this time. Pending means listing under contract. So year over year, we have more homes under contract now than last year, but fewer than last month. Makes sense. Summer slows things down, and the deeper we get into the summer, more things have tapered off. So for closed listings are up year over year. Average price per square foot is up year over year. The median sales price is up year over year. The listing success rate is up 5.2% year over year. Interesting, because we have fewer active listings. So sellers have less competition and higher success rate. Month over month, it's lower, probably seasonal. So if you're thinking about selling, summer isn't the worst time to be on the market. It'll be a little slower, but it's also, excuse me, it's also much less competition. A lot of sellers pull back in the summer because of vacation, kids are home, the heat. If you are willing to be out there, there are still buyers, and your home might be, the right one for them. Keep in mind when timing the market. Spring brings more buyers activity, but also more competition. So, pros and cons. Contract ratio is up year over year, 10.5%, meaning more activity overall. List price to sales price ratio is up both month over month and year over year, showing strength in how homes are priced relative to what they actually sell for. Days of inventory is down, consistent with lower active listings. Annual sales rate is up. We're selling more homes this year than last. Mostly dollar volume is up, adjacent to the number of working days per month. Bottom line, higher home prices, fewer homes on the market, a better list to sales price ratio, and a higher contract ratio. It's not a bad time to be on the market, especially as a seller. And as a buyer, you're seeing a more balanced environment, not the craziness of the past, but a bit more negotiation room. I've been talking with folks who are thinking about buying in this market. If that's on your mind, use the link below to set up a discovery call and see if this makes sense for your situation. Want to switch gears a little bit. The new housing legislation has probably been popping up on your feed a lot. Thanks again to the Crawford report for consolidating this. It's very interesting. There's been so much discussion about what this bill would do, but what's actually got left out. So it's interesting. There's been so much discussion about what this bill would do, but what actually got left out is arguably more significant than what went in. As of a recording, the president still has not signed it. So here's Comfort's take on it. So Comfort's take is to someone who's been following the housing market, what was left out of the act is probably more significant than what went in because a lot of good ideas got tossed around and didn't make the cut. Specifically, no ban on build-to-rent developments, no requirements for institutional investors to sell existing properties, no ban on institutional investors buying new builds, no forced sale of build-to-rent properties after 7 years, no ban of institutional investors buying or selling to each other. Our institutions are still permitted to buy, renovate, and rent. Institutions can buy resale homes if they have established rent-to-own schemes for residents. So a lot of the talk about reining in big investors and how they skew the housing market. A lot of talk about reining in big investors and how they skew the housing market. Most of that didn't actually make it into the bill. Most of the remaining provisions are aimed at encouraging planning to develop more housing at the affordable end of the market. But this bill will be a slow, steady process, and the effect on the market will similarly gradual and gentle. Don't expect any major changes in supply anytime soon. So a lot of conversation, a lot of headlines, but overall it feels pretty meh. Not a huge change for anyone right now. Maybe down the line we'll see some impact, but as it stands, probably isn't going to make any change in today's market. Where are we with mortgage rates now? We actually got some news today. This is, I want to say Tuesday as I'm recording. Mortgage rates fell to their lowest level in a week. That's great news, sitting just above 6.6 at 6.64%. Rates moved lower again following a lower than expected inflation reading. Yesterday's CPI had a bigger impact on the bond market, but today's PPI wasn't far behind. Bonds held on to the improvement into the afternoon, which let lenders drop rates even more. all the CPI and PPI news affect mortgage rates along with anything coming from the Fed. And the Feds have been pretty firm on holding off on cut rates, which isn't very encouraging to the markets. That's part of why rates have stayed fairly stubborn. The conflict with Iran is also having an impact on all of this. So that's where rates stand. Nothing too exciting. We definitely expect rates to improve more this year, and that improvement just hasn't materialized yet. I mentioned there's a new player in real estate. You may have heard this one. Kelley Blue Book is jumping in. Yes, the same Kelley Blue Book that does cars. Now they're doing real estate because why not, right? Yes, the company known for vehicle valuations is entering into the real estate world. So they are entering into the real estate world with the goal of providing a tailored strategy to achieve. So yes, the company is known for vehicle valuations, as I stated. They're entering into the residential real estate with the goal of providing a tailored strategy to achieve full price. They're jumping in to compete with the other companies that give you home value estimates and then pair you with the agent to get the home sold with their own package programs. This hasn't hit the market yet. I believe it launches around August, and I believe Phoenix will be one that launches in the market. It'll be interesting to see how this all plays out. It looks like they'll still be using algorithms to estimate home value, claiming it will be within 3% of what your home could actually sell for. I don't know if there's anyone actually reviewing that data for you, so how reliable that really remains to be seen. But they sound like they're guaranteeing it to some degree. I'm going to pull this up too. More information. It seems like another income stream for the company, generating leads from homeowners who want to sell, then having agents pay to get connected with these homeowners. A couple other companies use a similar model. So it'll be interesting to see if this one sticks around. Phoenix always seems to be the test market for these real estate companies. So I'm not surprised. We'll see how it goes, but that's now on your radar as something coming soon to our market. And if you don't want to wait for Kelley Blue Book and you want a home evaluation now, specifically an accurate one, I have a link below for an instant home value estimate. It'll give you an idea of what your home could potentially sell for, and I am happy to share more that interest with you. It's all in the link below. I want to talk just a little bit more about the comfort report numbers. CMI is at 80.7. Demand is at 82.2. That ticked down a bit. Supply is at 102. So supply is only about 2%, about normal, not as elevated as it's been. Demand is at about 18% below normal. The market index is at 80, indicates we're in a buyer's market. Looking at major cities, a mix of green and red arrows. The mortgage change on average is down 1.3% from last month. Cave Creek up through Fountain Hills is in a seller's market. Gilbert through Tempe is in a balanced market. Goodyear through Queen Creek is in a buyer's market. Not a ton of movement in which cities sit in which category lately, and not a lot of movement in the CMI overall, since we're not seeing a big swing in supply and demand. Looking at the contract ratio heat map, there's a lot of cold, which is the blue. So territories in Phoenix, South Scottsdale, and Central Phoenix. The warmer areas outside of that, on the key, green is the balance slash warm market. The blue is colder. This measures how many active listings are under contract. Warmer spots include Phoenix, the 85019, a couple Glendale zip codes, including Peoria, Youngtown, North Scottsdale, so the 85255, and Stanfield. Through Stanfield only has one active and one under contract listing, so take that for what it's worth. Unfortunately, if you are looking to buy there, there's basically nothing available on MLS right now. Still, it's useful to look at which areas are warmer and colder right now, whether you're looking about if you're thinking about buying or listing. Don't forget to book a discovery call if you are thinking about buying or listing. A couple weeks ago, I shared more about new construction incentives. Those are still going strong. I'd be happy to talk through with you further. As you know, I'm in North Phoenix. I'm around TSMC, and there's a ton of new builds going on right now. Or if you just want a home value estimate, again, the link is in below in the description. Don't forget to subscribe, and I will see you in the next video.